How's it going, everyone? This is Jesse with Stone Cold Investors, and welcome back to another, let's say, subpar stock valuation from a totally, unqualified stranger from YouTube, and that is me. So, yeah, let's get into it. All right, so today we're going to be checking out Tesla. Tesla reported earnings, yesterday, I think? So, yeah, it had a nice move up. But yeah, let's go back and just look at the history of the long-term chart on Tesla right now. So obviously we can see we had a lot of consolidation over through, like 2014, 15, 16, 17, 18. We broke out in 2019, made that run, crashed down during the COVID crash, and then it was just off to the races all the way up to 1200. So I've got some Fibonacci lines here, and just more for fun. But if we go into 2-year, we've been downtrending with the overall market year to date, and we had a nice little breakout above certain Fibonacci lines right here. So we'll see what happens in the short term. But yeah, let's get more into the fundamental analysis. I'm still waiting for. I wonder if I could copy that over. No, I'm still waiting for some of my applications to update to get the data over so I can dump it in my valuation model. But this is kind of what I have for my valuation model right now. And yeah, it's making me be very picky with any type of entry on Tesla. Held Tesla for a while and then I sold it when it was up near 1,000. It was when I offloaded most of my position. I'd love to own it again someday if the valuation makes sense and the price is right. But it's just about kind of tracking the company. I can root for the company and be on the sidelines. I'm fine with that until it makes sense to buy it as equity and as an investment. I don't have any problems just waiting for years or never even buying it if I don't buy it. I still have exposure via index funds and via QQQ, so. Yeah, I got my little share of Tesla, I guess, technically. From a bottom line perspective, we can see that right now, and this doesn't take into account the latest financials, because I haven't imported those yet. But right now we're looking at like yields on bottom line yields compared to total market cap of around 1%. Our risk-free rate's at like 3.23. So we can see that we're priced in heavily for growth here. So how this model works is that essentially on high growing companies, if the equity is yielding below the risk-free rate, it means you're priced for a lot of potential, a lot of growth. If we go to something like more mature like Apple, look at my Apple model, we can see that a lot of the equity appreciation over this time. All right, so we can see a lot of the equity appreciation over this time was actually really due to just multiple expansion. We've had this huge run, and if we go back to the valuation sheet on Apple, we can see that it's not like the yields stayed the same and bottom line numbers just increased. The yields actually compressed down towards the risk-free rate, which means that the overall equity price was increasing at a greater rate than the bottom line fundamentals were increasing. So we had multiple expansion for Apple over the last 5 years, 10 years, rather than the multiples just staying the same and underlying fundamentals just going up. So a lot of times I'll indicate just the health of the business, how the business is viewed, if the overall market is really bullish on the company, if it's deemed to be low risk, has a good cash position, good balance sheet, all that. A lot of times we'll get this multiple expansion and the contraction of yields, bottom line yields versus market cap, down closer to the risk-free rate. So yeah, so let's go back to Tesla. I was recording, or I was talking and I wasn't recording, so that was really frustrating. But so here we are back at Tesla. You can see that I kind of went with a base case of saying, you know what, like a 1% yield. So or a 1% yield spread. So that would mean that if the risk-free rate was 3%, then the Tesla's yield to fair value would be like 4%. Okay, and that's pretty close. I mean, that if you're doing 1%, it's like, you know, it's going to be a more mature company. It's going to be stable. But Tesla is very interesting in the fact that market cap wise, it has a huge market cap, and it has a lot of growing of the bottom line to do to actually really justify that market cap. And the growth runway, I don't know how long the growth runway for Tesla on the bottom line is going to be. You know, people can theorize things, but yeah, I think if they did 55%, that'd be amazing over a 5-year period. 40% I think is realistic. I think they're going through their kind of S curve right now, where you start off, you're ramping up, and then you're getting profitable on an exponential basis, and then you're kind of flattening out, right? So I think they're somewhere in that S curve right now. I think 25% year over year bottom line growth, especially if they can get improved processes and increase margins. 25% bottom line growth over the next 5 years should be pretty, I would hopefully say, easily doable. 15% would be the bearish case that I have laid out here. So yeah, and based on that, like I'm really looking at Tesla at $200. That's probably where I'm starting to get interested in it. And the range is just so crazy with Tesla. I mean, yeah, it's crazy. Between the bearish cases, or the like kind of lower, more moderate growth cases, the high growth cases, just throws off your 5-year valuations like crazy. So there's a lot of potential. There's also a lot of risk, because if it doesn't pan out, and you know, Tesla ends up growing at, you know, 25% bottom line, and maybe the market re-rates it and says, okay, this isn't going to be the 50, 60, 70% compound bottom line grower that we thought it was going to be for the next 20 years or whatever, then it gets re-rated, and you can, you know, fair value at that price at that point, it's like 165 in 5 years. So there's a lot of opportunity. There's also a lot of risk. So this model is just kind of my way of trying to see all the different sides, and then assign probabilities to those sides, and manage my allocation based off of what I believe those probabilities are going to be. So yeah, there's like 1,000 ways to value a company. There's like 1,000,000 ways to skin a cat, right? So same thing with valuing a company. Everybody's going to have their own opinions. They're going to have their own estimations. They're going to have their own models and the metrics that they're looking at. This is just the metrics that I'm looking at. So I hope this was interesting, at least. And hopefully next time my recording setup doesn't die in the middle of it. But yeah, I hope you got some good value out of this information. And yeah, this channel is just going to be me kind of talking about stocks that I'm looking at, and hopefully just growing as an investor and learning and reflecting on my old videos and seeing where I did well, where I went wrong, and improving going forward. So if you like that and you want to stick around, go ahead and subscribe, hit the like, and yeah, I'll catch you in the next one.